Keeping emergency cash dormant in a standard savings account forces your money to lose purchasing power to inflation every single day. Hold $5,000 in a conventional savings account at the 0.46% national average, and in 1 year, it grows to exactly $5,023. Contrast that with a high-yield savings account. At a 4.50% rate, the return shoots up to $229 over the exact same time frame. By what mechanism can one account mathematically afford to pay you up to 15 times more interest than another? A disparity in yield that massive naturally suggests a catch. In finance, a significantly higher return usually points directly to a higher hidden level of risk. It's completely logical to assume a high-yield savings account must be a volatile investment product, simply posing as a safe harbor for your cash. However, the absolute baseline of bank safety in the United States is federal deposit insurance. The FDIC and its credit union counterpart, the NCUA, protect consumer deposits in the event of a bank failure. Both your traditional brick-and-mortar checking account and a modern online high-yield savings account share the same government backstop. Your money is legally insured up to $250,000 in either institution. Because the risk profile is identical, that 15 times difference in yield results entirely from the bank's operational architecture, rather than a risk premium. To understand the gap, we have to look at the business model of legacy banking institutions. Operating physical bank branches requires continuous, massive capital. The bank must purchase and maintain prime commercial real estate, pay regional utilities, and staff every location with human tellers and managers. On top of that, there is a secondary layer of infrastructure: the deployment, physical stocking, and maintenance of extensive 24-hour ATM networks across the country. The convenience of walking into a physical building is a luxury service. You pay for that service directly through a brick-and-mortar tax, an artificially lowered interest rate on your deposited funds. Online-only institutions operate as the structural opposite to legacy banks. By completely eliminating physical branches and teller salaries, online banks drastically slash their operational overhead. This creates an excess of capital, which they redirect back to the depositor in the form of higher yield to attract new accounts. There is a practical trade-off. In exchange for this redirected capital, you surrender in-person customer service, the ability to deposit physical cash, and often a dedicated ATM card. This diagram illustrates the modern digital workaround. You simply link your high-yield vault to a traditional checking account at a legacy bank, allowing you to move money between the two using rapid electronic transfers. High-yield banking functions as an arbitrage strategy, allowing you to optimize where your cash sits based entirely on its immediate utility. There is one primary mechanical caveat to this architecture. The interest rate on a high-yield account is variable. It can change from month to month. This contrasts sharply with a certificate of deposit, or CD. A CD is a savings product that locks in a guaranteed rate for a fixed term, but charges a heavy penalty if you withdraw your cash early. Because funds in a high-yield savings account remain entirely liquid, the banks index their yield directly to the monetary policy set by the central bank. If the Federal Reserve lowers the Fed funds rate, your bank will likely lower your yield soon after. An account like this trades rate certainty for absolute liquidity. That makes it a reactive financial tool, rather than a set-and-forget long-term investment. So where exactly does this tool belong in a broader financial portfolio? High-yield accounts perform poorly as transactional spending tools because they lack ATM access and they cannot match the stock market for long-term wealth building. Its optimal function is serving as a highly accessible, inflation-resistant bunker. It is exactly where you should store an emergency fund covering 3 to 6 months of living expenses. This interface shows its secondary utility. Many online banks allow you to organize capital toward large, mid-term goals by breaking a master balance into distinct sub-accounts, visually separating a house fund from an auto deposit. Ultimately, the account acts as a dynamic holding pen. It protects your principal's core value without ever locking it away. When you are ready to open an account, do not simply select the institution advertising the highest percentage rate. Check the compounding method. Banks can calculate your interest daily, monthly, or quarterly. Daily compounding generates a slightly higher true take-home yield than monthly compounding on the exact same principal. You must also check for hidden institutional limits. Some accounts enforce minimum balance thresholds. Falling below these minimums triggers maintenance fees that will immediately offset any interest you've earned. Taking 10 minutes to logically separate your savings from your spending into an optimized digital architecture legally protects your principal, while forcing your dormant capital to finally work for you.